but we're going to go ahead and get started and kick things off. Welcome to our June 2022 meetup between founders and investors. I am Michael Mobitz, one of the co-founders of Brandjectory, and I'm here with my partners, Tom Malengo and Susan Bryanton of the Litchfield Fund, a family office out in Scottsdale, Arizona. And we have an awesome panel today. We're going to be learning a lot about the right vehicles to be using for investments at different stages of a company's life cycle. With that, let's get to it. I'm going to hand it over to Tom to start the panel.
Hi there, I'm Tom Malengo from the Brandjectory team. If you folks don't know me, hello. I wish I could say hello to everybody I do know on the call. And I thank you all for being here today. Our goal today is to share a lot of information with you, and we have some incredible people to do that. One of the things that we hear from a lot of founders, a lot of times is, should I use a safe note? Should I use a equity? Should I go for debt equity? Should I use a convertible note? What's right for the stage I'm at? What does that mean down the road when the next set of investors come in? And that's really what we want to talk about today. We want to talk about when you're pre-revenue or very early stage, what are the right vehicles to use? And our investor partners, who are Giuseppe Infusino from InvestBev and Ricky Jagota from Jagota Capital, are going to discuss that aspect of it, of what they like to see. What does it mean to use a safe note versus equity versus debt, and what do they look for when that's happening? And then we're going to turn to Jeremy Halpern of Nutter and Steve Plattman, who I don't see on my screen right now, but I'm sure he's here, from Anchin. Jeremy's going to talk about the legal aspects of those at each stage. And again, and then from Steve's perspective, the accounting issues, and what does that mean as a brand grows, as the next set of investors come in, as you enter that next round. So we're going to start by talking about that pre-revenue, pre-seed, seed, early stage, very early stage rounds. And we're going to start with Giuseppe. If Giuseppe, I'm sure he's here somewhere. I don't see him on my screen. But Giuseppe, turn it over to you and talk a little bit about, when a brand is in that pre-seed, seed, early stage round, and a lot of brands are asking these days about safe notes and what does a safe note do for me? And it's a little confusing because not everybody in CPG is familiar with that. So those kinds of things, Giuseppe, if you could take the floor for the next few minutes, love to hear from you.
Yeah, thank you, Tom. And I just want to clarify. So our company is InvestBev. Sounds very similar to InvestBev. No problem. We're still in the alcohol space, but I don't want to take credit where it's not due. But in any event, so it's a great question, right? You see it a lot as folks are starting out. I mean, people are when they're starting a company are coming from very different positions, right? Some companies are started by wealthy folks or friends and family that can put them in a position to start with a kind of a full coffers and not have to worry as much about this as others. Obviously, that is helpful, but not everybody's coming from that perspective. So if you do need to raise capital from outside sources, where do you go, right? So there's a lot of different options, right? There's debt, there's safe notes, convertible notes. Obviously, the first step that I would always advise people to think about, and probably have covered in other instances, is something you don't have to pay back. So if you can find a way to get a grant, there's a lot of different organizations that do things like that. That's the first thing to try to work your way through. But if you're going to go through a proper vehicle in the earliest stage, it's my experience that a safe note is kind of the way to go, because the alternatives are harder, right? So convertible note and a safe, and just kind of to take a step back, a safe, what that means is a simple agreement for future equity, and what it is just that it's very simple. It says you're giving me X amount of dollars as an investor, and we're going to figure out down the road how much of my company you get for that. So it's very simple. It's very quick. It is beneficial to the founders in that you don't have to establish a valuation early on that's hard to crystallize, and no matter what that valuation settles on, it's going to be very dilutive to you to raise capital and give away equity when you have very little or no revenue, right? So a priced round where you'd say you're getting 10% of my company for X amount of dollars is very hard to do in the very earliest stages, in my opinion. And it's typically beneficial to the investor because you can get more for your money very early on when the company is in a position of less dominance. But it's more beneficial to the company to issue a SAFE and kind of kick the can down the road just slightly. A convertible note is a very similar kind of construct, except there's interest associated with it. So that is more GP or more investor friendly. They may prefer to do that route. Again, it's putting you in a position where there's no equity being sold today, but what it's saying is we're going to have debt. You're going to give me money and I'm going to owe it back to you with a certain percent of interest, or down the road, we're going to take that original money you gave me plus the interest and convert it into equity based on the price of a round of raising money down the road. So if you think about it in sort of a spectrum of what's brand favorable to what's investor favorable, I would argue that a SAFE is the most brand favorable, and a priced round is the most investor favorable, and the convertible note is somewhere in between, in my opinion.
So, Giuseppe, one question before we move on to Steve and Jeremy to talk a little bit about it. As an investor, when you're looking down the line, and I know you do some bigger deals, okay, you're parts of some bigger deals. If you see a SAFE note out there, what does it do for your thinking at that point in time when you're leading the next round or you're participating in a much larger round later on? Convertible debt is pretty obvious, and certainly the investors in early rounds that are in equity are very diluted in future rounds. But now we have these investors coming in the SAFE note at a priced round later on. What does that do from your perspective as an investor? What do you think about that?
I mean, you're having to consider that the cap table that you see is not the cap table that will be, right? Because these SAFE notes, these SAFEs are going to convert and take a piece of the pie. So that's going to, one of the things that we think about is at various stages of an investment, right? How much equity does the founders still retain, right, down the road? And so by giving up equity early on in a price round, they do get diluted, of course, but you're also getting diluted down the road. So giving equity early is pushing down the owner or the founder's share. And the same thing with a SAFE. It's less so because it's happening based on the price of the subsequent round. But I don't view it as a material negative. I mean, we understand what it's doing to the cap table, but at the end of the day, a brand had to get to where it is today somehow. They need to raise capital, and so I would view a SAFE as the most favorable. That might be different than other people's opinion. But another thing to think about, and I think you said legals coming up. If you have priced rounds earlier, those investors are going to get much deeper on rights and so forth for subsequent rounds. And so they typically kind of compound on themselves. If one group gets this, then the next group wants that and so forth. And so that's why I think a SAFE keeps it simple and doesn't put those things in place that makes it more difficult for me to, as an investor in subsequent rounds, to negotiate that.
Thank you for that. That's fantastic. So Giuseppe mentioned the legal aspect, so why don't we jump into with Jeremy and find out a little bit about when you're working with a young brand, especially pre-revenue, and they're looking at a safe note or any other instruments. What are your thoughts? What are your concerns or advice that you share with them at that early stage?
Sure. Hi, everybody. Jeremy Halpern at Nutter. I'm happy to answer additional questions offline, and I'll leave my email in the chat here. So I'm going to disagree with most of the things Giuseppe said, although he is exactly correct about the structure of the safes and notes. I've been doing this 22 years as both a lawyer and an investor. And what I have seen over the last 6 years or so in particular is that most of the times the thesis that entrepreneurs have about a note turns out not to be true, both notes and safes. He used the phrase you hear a lot: kick the can down the road. We're not going to value the company today, we'll value it tomorrow. By delaying the valuation moment, we're going to allow you to build value and thereby decrease dilution. But a couple of things are happening in that story. Number one, there's 4 conversion moments you have to account for in a safe and 5 in a note. And each of those typically does have a negotiated value attached to it, sometimes fixed, sometimes as a function argument of revenue, but usually fixed. So you're negotiating value whether you think you are or not. Number 2, because notes typically have both caps and discounts, you are behind where you were a minute ago the moment you signed the deal. Right? You have to build enough value in the company to overcome the interest effect in a note and the cap and discount effects of a note or a safe in order to get back to the thing you think is going to happen. And I'm just going to give you an easy example to make sure people are thinking about it. If you have an investor who's willing to do an investment at a $5 million pre-money valuation, or let's say $4 million, and put in $1 million, so they're going to get 20% of the company. And instead you do a note with a cap of 5 million, you have made the wrong choice every time, because that deal can only get worse for you and only get better for the investor, but not the other way around. That's a maximum. In order for you to have the investor pay the cap, you have to actually do the subsequent deal at the cap over 1 minus the discount, right? So if the cap is at 5, you've actually got to get somebody to effectively pay whatever the math is, 6 and change in order to get the old investor to pay at 5, right? Because they get the better of that $5 million cap, or typically a 20% discount. So what you often see happen is people think they're doing the right thing, but you fast forward about 18 months later, and there's 2 things that make that really painful, which is 1, they haven't grown enough to outpace the discount effect. And number 2, the next investor for about the last 5 years or so will treat almost every note and safe that wasn't issued within the last 30 days or so as part of the pre-money valuation. So if the next investor shows up and says, I'll give you a $5 million value, and you have $2 million of notes outstanding, what they're really telling you is they're going to give you, the founder, a $3 million value. And they're assigning $2 million of that value plus discount plus interest to the investor, right? It's all coming out of your end of the deal. And so that becomes very painful for people very quickly, and they don't see it coming. And so and again, I don't think that means the investor did a terrible thing to you. It's a consequence of a thing that plays out too often. So my strongest advice to you is always have an Excel model that translates the gobbledygook that is a safe or a note into actual economics, so that you are crystal clear about what happens to your ownership at the time of a subsequent investment. And you can model it. You can say, maybe we raise $1 million in the next round, maybe we raise 3, maybe we raise it at 4 million or 7 million, whatever it is, but really have good insight into what's happening. Number 2, the old days of the safe as like the quick and dirty instrument have kind of gone by the wayside, because when you're working with angel investors, that's often true. But when you're working with venture investors, any institutional fund or even family offices who represent other people's money, you're often subjected to some of the exact same conversations. They want a side letter for things like preemptive rights. They want a board seat or a board observer seat. They want certain kinds of other control provisions. So we've done safe deals that look, from a documentation standpoint, pretty much like a priced equity deal. And it used to be that the one major advantage of a safe for a note, that it was quicker and cheaper. And these days, that's often not true. Just depends on the deal.
Hey, Jeremy, can I ask
please.
about the first piece again?
Yeah, for sure. Please.
So on the part where, so you made the example to say, if you raise at a $5 million valuation today, or issue a safe with a $5 million cap today, like, of course, to your point, that would, you'd be better off with the former than the latter. But typically, wouldn't you say that you're a safer note is kind of betting on your growth because the safe is going to have a much higher valuation than you could get today, or the note cap of higher than you could get. Otherwise, you might as well just have the round as it would be priced today by whoever would price it that way. So a little harder.
I absolutely agree with you. It only makes rational sense to agree to a convertible instrument with a cap that is out of the money. If you think it represents the current value of the company, you've done it wrong. But two problems occur, which is one, there are many investors who don't think that way, and they'll say, no, I want a $4 million cap. I want a $3 million cap. And that's roughly within the range of what you could do on a priced round. So that's the first problem. The second problem is, how many of you are entrepreneurs? Raise all your lovely hands, right? All of you suffer from what I believe the Fed chairman once called irrational exuberance, right? Next year, I will be $10 million. So you get someone to agree to a $10 million cap and you think, aha, I have won. They will actually pay this much higher price. But the data does not support that that's how most of these deals play out. In fact, most of them, there isn't enough hypergrowth, and the companies end up doing deals at or below the price they could have gotten before they had data. There's an old joke: you can sell investors on the data or the promise, but not both. So at the very beginning, when you have no data, you can say, we're going to be worth $1 billion. We're the next buy, we're the next vitamin water. You can say whatever you want. Once you've been in the market for 18 months, you are hostage to your actual data. And so oftentimes valuations go down, not up, over those first 18 months as the company is really trying to tune its product and find product market fit. And so unfortunately, what happens is then you do get stuck with those interest effects and discount effects. And a lot of these instruments also have a thing called a liquidity premium that says if you sell the company or do something else, it's effectively the investor getting like 1.25 to 2x their money, which is not irrational from their standpoint, but it means, again, that you're agreeing to things you never would have agreed to in an equity deal. Had you done the equity deal, it would have been a 1x preference without full ratchet anti-dilution protection. It would have, it wouldn't have had a 2x preference. But when you do it as a note or a safe, you see it all the time that people are agreeing to these multipliers. So it's just the kind of thing of be careful. Internet wisdom is not your friend. And you know your company and your deal and who your investors and what the conversation is you're having. And work with your counsel. There are deals that work out great on notes. We're in the middle of one now where we're converting over $7 million of notes the company took in early, and at high enough prices, and they've done enough growth that it's worked out. But we've done others that have gone exactly the other direction. So just be thoughtful as you go into it.
Thank you, Jeremy. I mean, I think one of the things that you did mention that really strikes home with a lot of folks as they do these early rounds is you always think next year, you always think the year after. We're going to be at 18 million and you're at 1 million today. The odds don't hold up. So thank you for sharing that insight, and thank you for the exchange with Giuseppe.
Tom, can I add one small last thing, because it's an important element, and it's not really a legal issue, but it's a relationship issue, which is those earliest investors are in theory, your biggest supporters, right? That's someone who hopefully can open doors for you, can make introductions, can add strategic advice and wisdom. And it's a really strange thing when you have someone sitting on your board or your advisory board who has a convertible instrument, who's actually hoping that your next round is not that good. it's strange for them too. They don't like that either. They'd like to be cheering your success. They'd like to know that the value of their equity is high. But at the same time, they're well aware that if the next round happens at a low price, they get the benefit of that. That is a dynamic that's really uncomfortable. And the one thing about a priced equity deal is once someone puts in at a price, they want the next money in to be at the highest price possible, right along with you. So there's a little bit better alignment there, and it's just something to pay attention to because it can create friction in early relationships, and you got to just kind of be prepared for it.
Yeah, very true. And as an investor, I've seen that happen, been part of it. With that, I'm going to go to Steve. Stephen, if you can tell us a little bit about what you think when it comes to, we're talking about the early rounds here, and then we'll go into the bigger rounds. But if you could give us some of your thoughts, especially around the use of these notes, these different styles of equity and investment.
It's interesting because Jeremy pointed out so many issues that come up with raising capital at the early stage. I mean, you got to be so careful, and you have friends and family involved here. You got to be careful who you're dealing with here. What's interesting is because when we get involved in the early stage companies, these companies come to us with zero revenue or close to maybe $1 million in revenue, and the first thing we deal with is, what is your structure of your company? Are you an LLC? Are you a C corporation? Tell me a little history about what's going on here. And the majority of them start out as LLCs. And I tell them right off the bat that when someone comes calling for a round of financing, they're more likely than not going to want you to switch to a C corporation. It seems to be the preferred way of doing things now. And there's pluses and minuses of being an LLC or a C corporation. Back to the talk about raising of capital. Up until a couple of years ago, I didn't really see much safes on the. I'm based in New York. I didn't see many safe investments. Most of my clients were doing convertible debt rounds at a discount, 20% discount with a valuation cap, and then they said, "Okay, let's go." I questioned a lot of those deals because the valuation issue. Because as Jeremy said, the numbers they present on day one never play out. They just don't. The revenue doesn't come in. The multiples aren't there. The losses are very big, and then they're not going out to raise the next round of capital. What typically I see is a convertible debt round, and then it converts automatically on the next round of financing, what's called a qualified financing, which is a defined term in most of these agreements. That's typically what I see. I really never see someone going to a straight equity round. It's just I don't see it. I like the convertible debt round is what I see. I like that round. But back to the structure question issue I was bringing before about the LLC versus C corporations. I'm not sure how many LLCs are on the call or C corps or ever. LLCs work very well at a very early stage. It's simplistic. The compliance issues with K1s and doing tax compliance is pretty straightforward. It's when you get additional rounds of financing, Series A's, seed rounds, Series B's, then it gets very complicated. And it all stems around the allocations that are enumerated in your operating agreements. That's where it gets very complicated. And that's where we spend most of our time understanding those agreements and how the losses get allocated. As I said, losses, very few of my clients in this industry have profits. Most of them are loss company. Jeremy, I think you would agree with that also, right? Most are loss companies for a long time.
Yeah, I mean, it's pretty rare. You see it occasionally in supplements and some other places that are mostly e-com where they can get to profitability fast.
Yeah.
But there is and Steve, you can give them more color on the Texas two-step of, you're an LLC for 12 to 18 months, then you flip in with a nice, increased basis of about $3 million or whatever. And then you magnify your 1202 exemption. And
exactly right. I was going to get to that.
Magic.
Yeah, right. So the first question I have is about the LLC to C corp conversion, which is it's a legal issue to convert from LLC to C corporation. The benefit of converting to a C corporation is the government and the IRS has given you what's called a Section 1202 exemption, which means you get a tax when you sell the company after holding the C corp stock for a period of 5 years. The government has given you a little freebie. That you get up to 10 times your basis tax-free from federal tax in the event you sell the company as a C corporation. So people don't really understand that concept, but it is a great mechanism to be a C corporation. So that's what people convert to C corporations. Very few people understand that rule, but it's a nice government-free thing they do for you. You're right. LLCs are also a completely, I would say, annoying compliance to deal with K1s, because when you have 3 investors, it's simple. When you get to 50, 60, 70 different investors with different classes of stock, the pecking order of allocations gets very cumbersome. And there's also sometimes people don't understand how it's allocated. And believe me, I've been in conversations, I'm sure Jeremy's been on calls also, where you're dealing with multiple investors trying to figure out who gets the loss allocation in that particular year or period. And it becomes just a cumbersome. So that's my thought on that. I don't see too many S corps in the structure at all, but most are LLCs. They go to C corporations, and they usually wait hopefully they wait to 5 years to sell their company. I've seen more and more companies been stretched out over 5 years in the last couple of years because they can't get the velocity, they can't get to the promised land of certain gross profits, certain margins and revenue that makes them attractive for somebody to buy them. So I've seen more and more deals go out more than 5 years.
That's great. Thanks. Great information, Steve. And yeah, the change now, I mean, many years ago, LLC, that's where everyone was. Now you're seeing so many brands convert to the C Corp earlier for the obvious reasons that you stated. And it is something that young brands get into that hassle with from the LLC perspective of K1s, reporting, all those mechanisms that have to take place can just be very cumbersome at those early stages. So thank you for that great information and the exchange with Jeremy. With that, we want to move and talk about the growth rounds and the larger rounds. The Series A round, we're going to combine them up because we want to make sure we give everybody time to be in the breakouts. So with that, I'm going to ask Ricky to talk about, again, the same instruments, but what he is thinking as an investor when it comes to the growth rounds and into the Series A round. I'll ask Giuseppe if he's got any additional thoughts, and then we'll move back to Jeremy and to Stephen to talk a little bit more about what that means from the legal and accounting side of it as you get larger and as you're looking at those larger rounds. So Ricky, again, I don't see you here, but I'm assuming you're on the line. So say hello if you're here.
Hello, everyone.
Hey.
Yeah, so as far from an instrument perspective, I think things get a little bit less and more exotic at the higher rounds, because that all tends to be normal price rounds for equity, and the instrument used the most is preferred equity, so that the investors get their money out first, often with some interest rate or preference, so that they're making a little bit of return on their money. Or as Jeremy was mentioning before, sometimes there's some liquidity preferences where they get 1.5 times or double their money back before anybody else gets a dime. And you'll find over successive rounds that the next investor who invests also has that same preference, but goes above the previous investor. And so you end up with this waterfall sometimes when you sell a company. If you've raised 4 or 5 different price rounds, that there's 4 or 5 different cuts to the capital before it hits any of the employees or the founders. And so that can be sometimes an issue. And in those rounds, we start to talk more about other instruments for folks besides the founder and the investor, like putting together option pools and how they're going to refresh for employees. Sometimes there are warrants that are given to your contract manufacturers in order to incentivize them to do business with you, or to lower minimums or leverage, some other part of the relationship, or some service providers. We've seen a lot of marketing agencies and supply chain folks also try to take advantage of that, either through some options or some warrants, so that when the company gets sold, they can participate in the upside. Occasionally, you'll still see some convertible notes and things being done. Mostly those are bridges between rounds when they need to get some money in. But people aren't ready to go through the process and the headache of the larger fundraise. And occasionally, sometimes you'll see people have felt like they've raised enough money and they're kind of they want to start hitting some escape velocity and focus a little bit more on profitability, and then so they may use a slightly more simple instrument in order to do kind of a final cap to their fundraise. The only other time we see some of this stuff used is when you have a larger firm making an investment that might give them control, or that might give them a significant chunk of the company, 40-45%, if not 50 plus. Sometimes they will step in with an initial investment, and then they'll come in and do a larger round. And sometimes those initial investments are made, as preferred equity. Sometimes they're made as some of these simpler securities, mostly convertible notes. And that gives you both time to get to know each other a little bit, but mostly it's giving that acquirer or investor an option to test the waters, get to know the team, see if you say you're going to do what you said you're going to do, and then move on from there. I think just two quick comments about the early round discussion. If I could build on that. I think the thing people get caught up in, I think Giuseppe and Jeremy both make compelling points. I think for most founders, where they find themselves in a position where they might like to do a price round because they're already negotiating a lot of those terms. We've seen in practice, at least the last 2 years, the cap on convertible notes is really just being treated like the price. And as Jeremy alluded to, that can only move against you if things change. And so, we find a lot of investors, at least the more sophisticated ones, are negotiating those down to be whatever the price is they'd be willing to pay in a price round right now. And I think one of the reasons founders find themselves still doing that, besides, even though it's a bad deal, as Jeremy alluded to, is that there's some more price and headache that you have to deal with as a founder and doing a price round versus doing one of these notes. Between legal bills and sometimes having to cover the legal and accounting bills for your investors, sometimes you're not raising enough money where being able to pay that slug to lawyers and accountants, and sometimes other third parties involved if you have a finder or somebody else, to really make it economical. Sometimes you just have to give away that extra 5-10% of equity, especially as a smaller company, in order to pay those fees. And a lot of people really aren't willing to do that. So, that's why you might see a lot of people using the convertible notes early on, despite these issues that, the valuation only moved against you, because on a practical basis, that's where, individual dollars really matter. And the difference between getting in 500,000, the difference between getting in 450 may be pretty meaningful to your operational plan.
Thank you, Ricky. Giuseppe, before I jump over to Jeremy and Stephen, do you have any comments about the larger rounds, the growth rounds, the Series A rounds that you'd like to mention?
Yeah, no, I appreciate it. And I think, Ricky hits on some of the points too around, the kind of compounding nature of having many price rounds on the liquidation preference and so forth. And that kind of weighs into some of the decisions that I was sharing on the earlier stage. But I would agree, right? The convertible note, I would say, is typically, I've seen more as a bridge in later stages, right? Where you're between rounds. I think there'll be especially pertinent today, where people are maybe, it's not to use kicking the can down the road phrase again, but in the terms of, it might be a harder environment to raise a lot of money. So you might want today, given the capital markets, so you might be more inclined to issue a convertible note for a small portion to get you, as Ricky said, a bridge to a proper round down the road. The other thing I've seen, and I think you kind of were talking about this, is if you're not actively raising, but a way to bring a strategic partner on board, and it's not going to be a price round, but we've actually participated in that capacity of being a convertible note, so you get a little bit of benefit from coming in, get a discount on the next round, but you get in in advance, and you can start adding the value that Ricky was alluding to. So I think that's I see that a lot. I think the convertible note makes more sense as you get further in your evolution than earlier. I think the state safe makes more sense earlier.
Thank you, Giuseppe. I really appreciate that. Steve, I'd like to turn this over to you and have you share. We've got about probably about 5 to 7 minutes here for you and Jeremy to share. But I do have one question. You, as an accountant, do you often, or do you see that situation in these larger rounds where people are looking for investors, a founder is looking for investor, and maybe there's a situation where debt or debt equity combination actually makes some more sense for them because they do have a great gross margin, they are paying money back, they could pay money back. So I just, as whatever you want to talk about, but it's a question that I have.
I've seen deals where debt and equity come into play. I've seen debt with warrants recently. I've seen debt with equity. Any combination works. I mean, some of these founders who like the debt equity model, who have the ability to repay the debt because they don't want to get diluted. I mean, these founders who are sitting there at 100% day one, sometimes you feel bad for them after a couple of years that they've been diluted and lose control of the situation because they've got there's so many equity rounds in the deal that they're down to 15, 20%. You feel bad. So the debt gives them an opportunity to pay it back if they can, if the margins are there and they're finding ways to do it, to make the payments. I like that structure. I mean, I've seen some recaps recently where, I mean, someone's come in and done a huge recap with a debt and equity situation, and there's some warrants attached, repaid the old debt, got better terms, and hopefully going to exit out down the road. That's what I've seen recently. So I like the debt and equity combination to give the founders a little chance to cash out down the road, because this is their life. They're visionaries. They brought an idea to the market, and you don't want to have them get down to less than 10% of the company, and you feel bad for them at that situation.
Thank you, Stephen. That's really good information. Anything else you'd like to share before we move to Jeremy?
No, what I would share about these bigger deals from the accounting perspective, make sure that the founder really knows their numbers and really knows what's going on in their business. I mean, some founders are more sales and marketing focused. Make sure you have a proper accounting team in place and functions defined, because the questions are going to come very hard, very fast, and you're going to need to know your game to get the bigger rounds of financing. I've seen it in tremendous amounts of diligence that I'm involved with, reading documents. Questions are coming up from potential investors. It's be on your game because they have the purse.
Thank you, Stephen. Yep, you're absolutely right on that. Jeremy, do you want to close us out on this topic with any thoughts about, from a legal perspective, these larger rounds, what founders should expect, what investors are looking for, and how that impacts, them as they continue down the path of being moving from founder to CEO, especially?
Sure. So 2 conceptual frameworks for everyone to think about, because it's hard to remember all this stuff we're throwing around at you if you're not familiar with finance. So just going to give you some concepts that are a little easier to lock in on. In any financing, but particularly in an equity financing, there's really 4 things being negotiated: value in, value out, control, and taxes. That's it. Who's putting what into the pot? Who's getting what under what scenarios, and how does it actually shake out at various outcomes? Who has the right to make decisions for this company and in what way? And what are the tax implications of everything we just talked about? If you remember that, it's then useful as you think about any potential deal, that there's an old joke in early stage investing, which is if you, the entrepreneur, want to set the value, I, the investor, will say, no problem, but I get to set the rest of the terms. And if you think that deal is good for you, you should run screaming out of this Zoom call immediately. Because what I give you with the left hand, I can take away with the right hand really fast. And if there's anything to remember in this stuff, is the value out equation is not limited to what valuation you took in the money at. If you take in money with that's got participation features, that's got accruing dividend features, that's got liquidation preferences, that's already really aggressive in changing the economics from what you think is the pro rata amount. Someone put in 15 on 45 and you think, oh, this is great. They got, or 15 on 30, let's say, right? They got 1/3 of the company. right? But as it turns out, they may have 40% or 60% of the economics when that thing is sold. And so you got to really treat it all comprehensively, not as just a question of the input price. Number two is that what you don't see coming as a founder is how this stuff plays out over time. And I bear some responsibility. I was part of the drafting team that put together these NBCA documents back in the early 2000s. So I had my, I added my comments to this thing, and what became standard, you have to remember, take seriously the idea that this is a document set put together by the National Venture Capital Association, not by the Association of Entrepreneurs looking to reduce dilution. That's not an actual thing, by the way, but feel free to form that. Why do I say that? Because there's things in there that, of course, the investors want to ask for, and they've now become so ubiquitous that we think of them as market, but we don't see the ramifications. And a couple of those very big ones, that get kind of ugly, are investors will often bargain for the right that you can't go do another deal without their consent. And that shows up in about 4 or 5 different ways. You can't amend the charter, you can't change their security, you can't have to issue new securities, whatever it is, they've got ways to say no. So imagine that you take in $7-8 million, the company runs for about 18 months, you lever up, and you're still running at pretty big losses, and something bad happens. Supply chain hiccup, customer loss, COVID, God forbid, whatever, something happens. And you go out to the market, and the market's not giving you very nice terms. And the investor basically says, we're not going to approve this other kind of deal. They can put you in a position legitimately where they become your only lifeline. And the downside of that is, imagine what the terms of that lifeline are going to look like when they have made sure that they are your only option. And I wish I didn't have to have this conversation, but there are funds that this is a little bit of the MO, and that you end up in a situation where you don't have optionality. And so, when you think about taking other people's money, remember that they have a job to do. They're trying to maximize the returns for their LPs. P.S., you're their LPs. They're investing your 401k money, in case you didn't know, right? So it's not like they're evil people. They're trying to do their job. But what that means is you can end up in a conflict based on these little tiny things that you weren't thinking about now, because right now it's the beginning of the marriage. It's, we love each other. They're going to help me. They're going to unlock all these doors. They're really committed to the company, and all that's great. And that's great until 18 months later when it's not great. And so you just have to go into it with a real understanding of what can happen and be thoughtful about how you prevent that. And the best way you prevent those things is, actual traction, communication, having options, always thinking about raising money before you need to raise money. The moment you need to raise money, as opposed to want to raise money, the terms are going to get uglier, and the terms with your existing investors are going to get uglier. So I agree with everything that was said. These are going to be priced equity deals. They're going to be expensive and complicated, but they're not that complicated. And you should really focus on, how does this play out a year from now, 2 years from now, rather than just being so laser focused on, I'm trying to get $5 million to blow out a sales team and do end caps in, every Safeway in America. Like that cannot be your only focus. So that's my tale of horror. Sorry.
Hey, Jeremy, I have one question, because this comes up all the time from my angle when I ask questions. Does it make a difference whether you're in Delaware or any other state where you do these? For sure. And occasionally people see, like, they don't quite figure who this is protecting, but Delaware is what's considered a management friendly state. And that's good for you as the management, meaning that the board of directors is given great deference, and stockholders in Delaware companies have very limited rights to go complain about things, which is not always true in other states, where those members in an LLC or stockholders in a corporation can have increased rights, meaning you, the director, have increased duties that can create a lot of havoc. So Delaware is by far and away the most predictable. It has the largest body of law related to this stuff. What it doesn't do, for all of you who are about to make a very unpleasant grimace expression, is being a Delaware company does not exempt you from the law of the states in which you are operating. So you cannot have unpaid interns in Massachusetts, right? You cannot fail to pay wages and properly classify people in New York. You have personal liability for that problem, right? The fact that you're a Delaware corporation doesn't do you any good at all.
So just be thoughtful about where you're forming and why. Investors, for the most part, you'll never have a conversation if you're a Delaware C corp. It'll just it's done. You can move on. You can focus on more important things. I've got one now. They're a Wyoming entity. There were reasons. I've got another that's in Idaho. And oh, okay, see, Joe. Are some reasons people choose things like Wyoming and Nevada for there were some tax reasons that were a little more relevant in other contexts. But for the most part, a Delaware C corp is the way that you can take that speed bump off the table, right? If you're Rhode Island, if you're Massachusetts, if you're California, those can cause people to be apprehensive about all of the other rules that come into play. That was a long answer to a short question, Steve. Sorry.
Actually, it was interesting. You made a comment earlier, and I think we're going to go to the breakout room soon. Companies raise capital, and the first question I ask is, when I look at their modeling or projection, did you raise enough money? Because as soon as you raise this capital, you might as well start the next raise because you're running out of money. Think about where you're looking to be and how much you want to raise. But as for cost purposes and expenses, you may want to raise more than you need to because the legal costs, the accounting costs, and all those other great expenses, you might have to reimburse the other side for. So think about how much money you're raising against how much money it's going to cost you to raise the money.
Yeah, it's also true, Steve, that no company failed for dilution, but lots of companies fail for running out of capital.
Exactly. And then what happens is when you're running out of capital, you lose all your leverage now in the next round because they know you need the money. So they're going to come after you and get that dilution and get those rights, and you're going to be stuck in a bad situation. So think about your long-term strategy and how much you need to raise. Raising, if you can raise, I've only seen one company raise once and exit. I've never seen anybody else do it. I've seen companies raise 6, 7, 8 times before they get to the exit, and you've lost track of how much money they spent on capital raising. Great for lawyers and accountants, but not good for the bottom line.
This is great conversation, folks. I want to get to 2 questions, one of which I think Giuseppe spoke to earlier, and I think he responded to Ryan in the chat. But Giuseppe, maybe you could just respond to that a little bit about what you see going on when negotiating the caps on the convertible debt.
Yeah, so I think this is kind of where Jeremy and I we're kind of thinking about this in different ways and have seen some different things. But the cap that typically is based on the future, right? So if the investor, or I'm sorry, the brand will typically set that cap based on when they think their next raise will be, and at that point, what they think their revenue, EBITDA, whatever kind of metric you use to work off of will be. Now you might get beat down on that, right, by the investor to say, your projections are totally unrealistic, but they might factor in on what discount those down or something like that. But it's going to be set that cap on a valuation multiple on where you think you're going to be at the time you think you're going to have that next raise.
Okay, thank you. I'm going to take one more question, then we're going to go into the breakout room. Remember, there should be an investor in every breakout room. Steve and Jeremy will be in breakout rooms. So, if you have another question, continue the conversation there. That's what we want you to do. Mark, you raised your hand. Do you have a question? Mark Lewis?
Yeah, no, I think the question was really around when looking when looking at safes and convertible notes, obviously, especially at an early stage, friends and family, you're going to have quite a lot of people on that. To what extent does that make for the messiness of that cap table inhibit you as you go into later rounds?
Steve, you want to speak to that?
Repeat the question again now.
So if I'm doing a safe or a convertible note, especially at a friends and family level, the likelihood is I'm going to have a lot of different investors, right? Even if my minimum investment amount is $25,000. To what extent, which tends to create not such a pretty cap table, right? To what extent, if that, especially if it's convertible, how much does that impact make you less attractive to investors when you start going into priced larger size rounds?
I don't think it has any difference at all. I mean, I will tell you, I've heard some amazing stories about early stage companies that had friends, families make investments, and when they sell, the multiple is crazy. I think it's the first place the question I ask is, well, do you raise money from friends and family? I mean, that is a psychological issue first, because you're asking your friends and family to make an investment in a company that they may lose all their money in. Okay? Once you overcome that issue, it has no bearing. I've seen cap tables with names of people. I'm like, well, who are these people? I said, that's my cousin. That's my cousin's whatever. It's irrelevant to that situation. It's the easiest money to get because you're selling your family on a dream. I don't think it's any problem at all with that.
I'd like to counter on that, because the moment you talk about voting rights, this is going to get really messy when you have classes where you have to, and I talk from experience, when you have a cap table with 200 people and everyone needs to vote, and Jeremy is laughing because he knows what I'm talking about, the company. It's easily fixed, right? You can have major rights provisions, but like if you have an experienced investor coming in, setting the terms, that can be fixed. The one thing I want to say is, like, you don't want to have everyone on the cap table giving voting rights, because you can't handle that. It's going to be very messy. It's the only caveat I have.
Oh, I agree totally, but I totally agree. But I had one client that had 315 investors. It was kind of crazy. It was kind of crazy to deal with. So I hear what you're saying, but everyone, it's my experience of what I've seen.
I'm just going to add one caveat, and then we're going to break into meetup rooms. But Stephen, what I've seen happen most often is that these early rounds, young founders are just trying to take in money. That one person gets a $3 million valuation, one person gets $1.5 million valuation, different times, different stages, and at some point in time, they need an accountant like yourself to straighten that cap table out and make sense of it, so that the next round investor really pays attention to it.
I will tell you this, and Jeremy probably has seen this more than I have, and I always make a comment to people when I get a client that is an LLC that's been using their family accountant, and I see all this crazy stuff on the balance sheet and cap table. I say, guys, I'm advising you to get an attorney that knows what they're doing in this space, who understands this nuance, and get what's called a legal cleanup. Right. Look at every document they have, get it organized in some kind of fashion, and then go out and go to the next level. I mean, agreements aren't signed. There's no agreement sometimes. It's just they throw in the money
out there at some price, and
there's some price that no one understands. And I said, guys, you just created this mess. You got to get an experienced legal person who understands capital markets and capital raising to clean this mess up. And it may cost them some money, but in the end, when they want to go sell the company down the road, it's going to make a world of difference if your legal documents are in order.
Jeremy, you look like you had one more comment, then we'll break.
Yeah, just as you think about these deals, number one, just never ever do cocktail napkin deals that involve percentages. We spend more money cleaning up deals that said, I granted so and so X percent. Never a good scene. So that's just one thing. The other is that there's lots of good resources. You're in a room full of good resources. Like, talk to people, and there's lots of investors who will be really candid with you about what's happening, and you can ask a lot of questions. So don't be afraid to go out and say to someone, we're trying to sort through this issue. What do you think? Let's get some feedback. That can be a really powerful tool in your arsenal, because the investors do this for a living. You do this a couple times, maybe in your life. So there's a massive information asymmetry. Do what you can to try and true that back up.
Yep.
Hey, thank you, Jeremy. Thank you, Stephen. Thank you, Giuseppe. Thank you, Ricky. Folks, we're going to break into the rooms. I wanted to get you there a little early, but this conversation is so good for you founders on the call here. You've gotten some great information from folks that have done this many times over, okay? So they have seen things, they've seen it all. We are so thankful to each of them for sharing their experiences, sharing their knowledge here. So with that, what I'm going to do is turn it over to Michael, and Michael is going to hit a button and get you all into your rooms. You'll have to click on join the room, and we're going to again ask the investors who are in the room to lead the conversation. At least get everybody to introduce each other. Make sure you put your contact information in the chats, share contact information, and ask any questions that you have left over from this. So folks, thank you so much, and Michael, do your magic.
Great. If you have any other questions, feel free to reach out, Michael@Brandjectory.com, Tom@Brandjectory.com. And we're glad you guys were here. It's great to see so many people, and we hope it was helpful. Have a great rest of the day. Take care, everybody.
Thanks.